Hello, good afternoon, everyone. This is Professor Rodrigo Olivares Caminal. I'm a chair in Banking and Finance Law at Queen Mary, University of London. We are waiting a few seconds until all the attendees sign in. So if you bear with us 10, 15 seconds, and then we will kickstart. Okay, good afternoon, everyone. Welcome to this fifth webinar organized by Universidad Complutense de Madrid and the Institute for Global Law, Economics and Finance from Queen Mary, University of London. Today, we have 4 international guest speakers, and we will be discussing together what are the challenges that are currently being faced by the financial system, and we will be focusing on the current environment and discussing whether, among many other things, whether are we facing a crisis, whether the financial system is prepared to cope with the crisis, what are the risks, if any, and we will be having hopefully an informal and dynamic conversation about the latest trends in this area. Before I present the speakers, as you might be aware, because this is the 5th webinar in the series, the idea with these sessions are to try to have a relaxed environment to exchange views and ideas. It's a group of experts that share a common theme or a common passion. And we will have a conversation where we will try to make this as interactive as possible. All of you are invited to post your questions on the chat box, and I will be moderating the event today. And I will also invite the panelists to feel free to interact directly among yourselves and also assist me in the role of asking questions, because I'm trying to replicate the feel as if we were in an informal gathering having a conversation. I will present the panel of distinguished speakers, which today we are joined by Eduardo Avila Zaragoza. He's head of Global Supervisor Relations at BBVA. We have Christos Gorsos, president of the academic board at the European Banking Institute. He's a professor of law. We also have Professor Rosa Lastra, the Sir John Lubbock Chair in Banking Law at Queen Mary, University of London. We are also joined by Martín Martínez Navarro. He's a referenciar at the Court of Justice of the European Union. And today we are also joined by my friend and colleague, Professor Juana Pulgar. She is my partner in crime in this series. She is the other co-organizer of these webinars. And without much further ado, I want to give the word to Juana, because she told me that she have a thought-provoking question to kickstart this panel today. So Juana, thank you for joining us today. Thank you for being my co-organizer, and the floor is all yours.
Okay, thank you very much, Rodrigo, for giving me the floor. Welcome and thank you everybody for attending this meeting. First of all, I would like to express my heartfelt gratitude to the speakers for having accepted our invitation to participate in the 5th and final event of this webinar series on the topic of post-COVID debt and finance, organized, as Rodrigo has already said, jointly by the Department of Business and Tax of the University Complutense of Madrid and the Queen Mary University of London. It is an honor to host you this afternoon, even if it is on a remote basis due to the new COVID strain that, as everybody knows, is giving rise to new restrictions all over the world. But we are truly looking forward to meeting you in person as soon as we can. As Rodrigo has already mentioned, I would like to share with you very briefly some of my thoughts and my concerns on the topic of challenges for the financial system in times of crisis, and put them on the table as a way to start the debate that my colleague Rodrigo is going to run as the chair. Well, as everybody knows, in the COVID economic crisis scenario, in comparison with the financial crisis of 2008, the financial system has not been a part of the problem anymore, but rather a part of the solution. In that sense, the financial system has contributed to the recovery of the economic system and the enterprises in a different ways, and above all, providing liquidity to the enterprises and the system, sometimes with support of public guarantees. But the point is, while the legal moratoriums connected to a COVID scenario were in force, the debtors were able to fulfill more or less their obligations. But my question and also my concern at the same time is, are you expecting a high level of non-performing loans at the end of these legal moratoriums in the different member states? Should it imply a risk for the stability of the financial system? Well, I just would like to know your opinion on it. The floor is yours, and we are all ears.
Thank you, Juana. Do you want to adjudicate the question to someone in particular, or?
No, feel free. Feel free. The participants feel free to start.
Maybe I can take it from the industry side, if I may.
Eduardo, yes, please, by all means.
Thank you. And first of all, thank you for the invitation. It was a pleasure for me to be here. Well, answering to Juana's question, the truth is that the portfolios are performing better than we expected. This is that all expected. Just to give you some numbers today, we at my bank we made public the year-end numbers. We share with the market that what is the deferrals that were affecting mortgages, consumer loans, and many SMEs, corporates are almost already finished and back to normal. So the impact that we are having on the non-performing loan ratio is lower than we expected. In general, the performance has been very good. So just to give you a number, out of the nearly 22 billion of deferrals granted by my bank, which means 6% of the total portfolio, the impact on the non-performing loan ratio has been not significant. We are keeping a 4% non-performing loan ratio, which is the same that we've been for the last quarters having and showing to the market. So in general, what refers to deferrals, the behaviors in not only in Europe but in the footprint that we do have significant franchise in Mexico, Turkey, Peru, Colombia, Argentina, has been better than expected. What referred to the still outstanding government-backed loans, which is around 4% of between 4 or 5% of the total group loans, being in Spain 6% of the portfolio. The performance so far has been good. Now what we face is, as Juana said, a moment here in Spain, especially with the ICO government-backed loans from April on. We will have to watch how will be the behavior of the portfolio. But just to give you a general view, the performance so far has been good. The number of clients that are expected to ask for further further extension, we expect to be not significant. And bearing in mind that at the end there is an average of 75% of coverage by the government to those loans. But in general, the performance of the clients is being better, and we have to wait maybe from now to June to see this step that we face on the loans backed by the ICO here in Spain to see the performance, but we are quite optimistic in general.
Eduardo, thank you very much. And this correlates with some of the data that we are receiving. For example, this week, there was 3 back-to-back events organized at the EBRD jointly with the launch of they have done a new insolvency assessment, which was launched on Tuesday, and there was another event on Wednesday and Thursday. I have to admit that I'm a little bit biased because I was who drafted that report, and I've been involved in the events. But we were looking at also the angle of non-performing loans and the impact that had. And so far, the fear that was originally envisaged has not translated into a direct increase in non-performing loans. And in our previous edition of this webinar, we had Professor Adolfo Ruilion. He's a consultant with the World Bank and also a former judge. And him and I, we were kind of exchanging views, and we were in agreement that we were converging on the idea that that is the case, and we were trying to find an explanation. And we identify 2 reasons that have always been identified as the cause. But do you see a reason why this has not translated in the concern that we all had? Why NPLs have not skyrocketed as some people feared at the outset?
Well, maybe one of the reasons is that when we see SMEs, corporates, the level of leverage that they had at the beginning of the crisis was low. I mean, in Spain and in other geographies where we have footprint, for years in Spain there has been a deleveraging process, and so we started the crisis with low level of leverage in the corporate side. Maybe it can be one of the reasons.
Thank you very much, Eduardo. And let's hold on that idea. We can come back to this in a minute if the conversation leads us into it. But let me switch quickly to Christos. Christos, you are in Athens at the moment, and I guess that you are quite familiar with the NPL phenomena, and I love your body language. That raising of eyebrows tells me a lot, and the smile confirms my suspicion. Christos, Greece has been at the core of the previous NPL wave on the back of the European sovereign debt crisis and some of the activity that took place in Greece during the IMF program and the activity of consolidation of the banking sector. Can you tell us a little bit about how you are seeing the NPL situation at the moment, and how do you see this either from the Greek perspective, or if you want to go a little bit further across the EU, I'll be equally happy.
Thank you, Rodrigo. Thank you for that question. Expected, yeah.
Okay, then the next one will be more difficult, so you don't expect it. Don't tell me that you have prepared this one.
Correct. I didn't prepare myself in the last 3 minutes, yeah. The situation has been really very weak in Greece since 2010. We have experienced a very high degree of NPLs in the south of Europe throughout, across the board, yeah. But unfortunately, in our case, it was close to, or even in some cases, more than 50%, 50% of the outstanding loans. And fortunately, one can today realize that this problem is not anymore on the books of the banks. The average ratio has decreased. Depending on the bank, yeah, it's close to 10% plus minus. which from the starting point of 50% is a huge development. And as a matter of fact, even though I belong to those, and I exposed myself by writing that I was fearing that a new NPL wave might result out of the pandemic crisis, this has not been the case. We can see that in the EBA dashboard. We can see it in all the published data that are available. Yeah. And I think that there are several reasons for this, including the fact that especially when it comes, this is a limited interpretation now, when it comes to new loans, yeah, we have a new framework in place. You have the EBA guides and mainly the ECB guide, yeah, in the Eurozone with regard to loan origination. And I think that this may have also contributed to these banks being very careful and being monitored more closely, yeah, being scrutinized with regard to the provision of new loans. Nevertheless, I still believe that we have not seen the end of this period of the economic cycle. Yeah, I would not be surprised if in the next months the numbers would deteriorate to a certain extent, but we can keep as an interim conclusion the fact that indeed we are not facing a huge crisis. We are not facing a huge crisis on that front. Yeah, and of course, and I close it here. The remark made at the beginning by Juana is one of the most important elements in our discussion. The fact that depending on the country and the business cycle during the last 5 or 6 years, the fact that banks had more capital buffers, yeah, what we call the Basel III impact, yeah, in order to absorb losses, may have also contributed to this overall development.
Christos, sorry, Juana, do you want to go?
And well, if I may, I would like to suggest that, well, in the context of the Commission's work on the Bank Union, the directive on early corporate restructuring probably seeks to contribute to preventing the accumulation of non-performing loans. In this context, the availability of effective preventive restructuring frameworks will ensure that action is taken before enterprises default on their loans, and thereby helping to reduce the risk of loans becoming non-performing loans in cyclical downturns and mitigating the adverse impact on the financial sector. I don't know your opinion about the directive on early corporate restructuring, but from my point of view, probably the transposition of this directive into the member states probably will ensure that action is taken before enterprises default on their loans.
Very briefly, I think you are correct that the objective of this legislative act has been, as you described it. I do not have any comparative data on how this has been translated into national legislation and what has been the impact of this. So this is an additional element towards this end, but I really don't know how it has been implemented. The news from my country, to the extent that I'm fully informed, is that the impact has been limited for the time being. But this is due to other structural problems. So overall, one can foresee that this will be another pillar towards addressing this issue.
Thank you, Christos. I can tell you about your country before I will go to Rosa in 1 second, but your country did extremely well in this EBRD assessment on reorganization. It was ranking on the top, and I will come back to the issue of linking insolvency to NPL resolution and also assisting the whole financial system. But from your intervention, Christos, what you are seeing is what a perception that I have is basically you still think that we might still be facing an NPL crisis, or at least not, I don't know if a full-blown crisis, but there will be probably an increase in the percentage of NPL loans. Rosa, you raised your hand. I don't know if you want to join the NPL discussion, but I would also like to ask you whether you think that in the cycle that we are at the moment, whether we are probably facing or walking towards some degree of greater distress, or whether you think that we might be turning a page. Rosa, thank you for joining us.
Thank you, Rodrigo, and thank you also to the Universidad Complutense for doing this with Queen Mary University of London, where I have the pleasure of serving together with Rodrigo as professor in the area of banking and finance. I just wanted to link what you're saying, given that the subject today is challenges for the financial system in times of crisis, and perhaps with your last comment asking Christos whether there is still some room for perhaps considering that things might not be as optimistic as they sound. It is true that post-global financial crisis, banks are in a better position. They have increased their capital and liquidity ratios, and they have been subject to a great deal of restructuring, which has led, in my opinion, to a more resilient financial system. However, though a crisis in NPLs has not materialized yet, there is still in the horizon some signs for trouble that we cannot ignore. One of them is the withdrawal of the pandemic support, which could create corporate distress and then will lead to debt restructuring or the need for restructuring and therefore NPLs. Another is that after years of monetary easing with ultra low interest rates and extensive quantitative easing programs, which have led to, many argue, over-indebtedness, and certainly on the side of the central banks around the world, in the developed world at least, or facing the return of inflation and inflationary expectations. And as economies recover from the COVID pandemic, the return of this familiar foe, which is explained by economists by a number of factors: increased demand, labor market shortages, disruptions and bottlenecks in global supply chains, shifts in commodity and energy production and prices, and the potential for green inflation, has led at the moment, and this is a debate that is taking place as we speak, whether the current inflation is temporary or transient or more permanently, and whether this could actually be the source of the next crisis, in the sense that the risk of choking the economic recovery could complicate the normalization of monetary policy, effectively the quantitative tightening which is needed to actually offload the massive amount of purchases of assets that central banks, the ECB, the Bank of England, the Fed have undertaken over the last few years, really more than few years, decade and a half. And I think that this is one of those issues which needs to be considered. As some of you may know, I was a specialist advisor to the House of Lords in the UK in an inquiry on the quantitative easing program that has been undertaken by the Bank of England, but similar ECB and Fed over the last 15 years. And in one of the conclusions of the report is that there is actually a divergence between the research that is produced by the central banks, which tends to be much more optimistic, and the research that is produced academically independently, which is perhaps less optimistic. And that one of the issues of concern, which obviously with quantitative tightening needs to be taken into account, is that not only do markets expect central banks to come and repress any volatility, regardless of the source of volatility, but sometimes they have come to expect it. And the entitlement to central bank support was one of the issues that was discussed in this House of Lords report. So this could still translate into the seeds of a crisis. And when we are talking now, it is true, and Eduardo gave data, which is is encouraging. But I wouldn't like to self-congratulate ourselves until we have seen the end of this cycle, particularly with the normalization of monetary policy, as well as the withdrawal of the pandemic support, which has led to massive expansionary fiscal policies around the developed world in those countries that have fiscal space. I think I'll stop for now, because otherwise I can keep
Rosa,
on talking.
thank you very much for that intervention. And I think basically that was very good, because that touched upon some of the issues. Basically, one of the issues in my transitioning from one topic to another, I wanted to address the issue of inflation, but that you have brought it very quickly into the forefront. And also you touch upon some of, I think basically, probably not expressly, but indirectly, to some of the issues that we need to consider when trying to address these questions. And one of them has been mentioned by Eduardo, which was the préstamos ICOs, the state loans to assist during the pandemic. Juana mentioned issues of the moratoria for companies. I also think that there are a couple of additional elements, like waiver of events of defaults by some of the lenders, because the crisis was affecting everyone alike. Also, market conditions, which probably would not be ideal to action on any of the collateral, or yes, but that's something which is more slightly strategic and one-by-one analysis. But I think that there are many underlying issues that also need to be considered, and I agree that there was a need to deploy the legal bazooka to attend the urgency that the situation had. And I think that there's still a lot to be seen. But before we continue with touching on all of these fascinating topics, Martin, I would like to go to you to see, because basically this has been, I think that at the moment we have many balls up in the air. We have discussed about NPLs, we have discussed about the financial system, whether we are, well, whether or not, I think that basically it's a general agreement that we are better than in the previous kind of shake of the pillars, which was a prior crisis, where basically in the aftermath of Lehman and the EU sovereignty crisis. So we are better prepared, but we are still facing probably an issue with NPLs, because we are not seeing the end of the cycle yet. In addition to that, we are starting to see inflation, and we will also see that basically state aid will be retracting, and also the moratoria that have been put in place in several jurisdictions will also be retracting. In the UK, for example, has been lifted already. So Martin, I don't know, there are too many balls up in the air. Which one you want to grab and start running with it?
Thank you, Rodrigo. Let me first start with 3 points. First is a confession. The second is a suggestion. And the third is an obvious remark. The confession is the following. Actually, among all the panelists, I am absolutely honest when I say that I am the only clearly who's not an expert in this field. I am not a banking lawyer. So this is not really my field of expertise. I am an expert in litigation, in particular in litigation before the EU courts. So actually, you know much more than I do about the specific subject matter that is of interest to us. So I say this with sincerity and not fake modesty. The second is a plea and a suggestion. I am sure that at some point, you, the panelists, but most importantly, I address myself here to the attendees, you will be participating in legal proceedings before the EU courts, whether your capacity as lawyers or as legal experts for one of the parties, or as witnesses. And the suggestion and the plea is, in your capacity and your quality as the real experts, remember always that You are the experts, but the court is not the expert in this field of law, because the court has a vocation of a generalist. So try to always to avoid technicisms and try to explain and make your case and your arguments as simple and as understandable as you possibly can in order to make them more effective. And the third remark, or the third point, which is an obvious remark, is that by definition, the court has a reactive function. The court does not decide what cases it addresses, and obviously also does not address the cases in real time. It addresses the cases years later after the facts. But this is important to bear in mind, because the things that are present in the economic life of today are not present in the dock of the court. The dock of the court is stacked with issues that took place in real life years ago. And in relation to that, let me say, just to throw also some balls back to you, that banking is being for the last few years an area of law in which litigation is exploding, and by force we are being confronted with the need to resolve an increasing number of disputes and an increasing number of complex disputes. Probably as a result of the previous crisis, as you know better than myself, the European Union decided to adopt a much stricter, stronger institutional legal framework to deal with crisis, and now we have a real banking supervision and a real banking resolution mechanism, which those two pillars provide super interesting questions for us to analyze that we are dealing with on a daily basis. To mention financial and banking supervision, we have lots of cases concerning the contributions by banks to the resolution funds. We have cases in which banks are unhappy, or the shareholders are unhappy with the withdrawal of the authorizations to act as a credit institution. We have cases concerning the declaration of banks as being of systemic importance, and so on and so forth. And those raises interesting legal questions regarding the admissibility. Who can bring these cases? The bank, of course, but what about the shareholders, the bondholders, stakeholders, broadly speaking? Can also they bring cases? And that's not always the case, to be frank. And then in banking resolution, we have obviously the landmark case, which is still pending, but the hearings took place already recently, and the judgments are on the pipeline and will be coming out in the coming months. The famous Banco Popular case. It's a litigation of over 100 cases, of which the General Court has selected, I think, 6 or 7 pilot cases that will cover the entire substantive issues and procedural issues which are of relevance, and we intend that this will exhaust the litigation concerning this Banco Popular, which, as I said before, remember, Banco Popular was resolved 3 or 4 years ago. Now it's kind of it's ancient history, but this is the reality of our daily work.
Martin, I slightly disagree with you with the ancient history element of Banco Popular. I can tell you that Christos, Rosa, and myself, which we are following closely some of these resolutions because the impact that they have forward-looking, Rosa, Christos, and myself, we follow very closely issues that have to do with bank resolution. Mm-hmm. And if you ask me, I think, I don't know Eduardo, and I know that Juan is more on the corporate side, but I think that after these words, I think probably Christos, Rosa, myself, we will be buying popcorn and sitting in front of the computer, kind of waiting for it to come out, because basically we would like to devour line by line what that decision will have. I think that because what you need to bear in mind, Martin, and I think your intervention is perfect to move towards the issues of where we are in the financial system with the rules, is that basically we need to understand that there have been bank runs since the Roman Empire.
Yeah.
Many years later, we are still facing the same problem, the same issues, banks collapsing. there has been a revolution in the legal dimension. What happened in the post-Lehman era has been a catalytic event. The fact that we have now a cross-border piece of legislation that brings together a number of countries under the same umbrella, that is huge. That is huge. And then we saw that basically the same law could be interpreted or applied with, I'm slightly more critical with certain differences in different jurisdictions. But that's why anything that comes out from the place where you're sitting can have huge effect on the whole system and basically for the whole system. So on that note, I would like to start turning into what is the current framework that we have. And since we were talking about banks, where basically, sorry, NPLs, which the ones that have the greatest exposure are banks. And Martin, since you brought the example, or sorry, not the example, you make reference to a specific case, which is Banco Popular, which is still fresh in all of our minds. I think that probably I would like to, I don't know if I should go to you, Rosa, to tell us a little bit about what is your current view on the legal framework that we have to deal with banks and with banks in distress, and basically whether you think it is enough, whether you think that there are still some holes in the regime. And Christos, start getting ready, because then I'm going to you with the same question, and hopefully you might give me an opposite view. Who knows? Rosa, do we have now the tools that we need, or we still need to keep on working and there are some gaps? And if there are some gaps, if you can identify them, that would be ideal.
We still have some gaps. We always have gaps, isn't it, in the financial system? We always need to keep on working. Otherwise, we will go out of job, and our job is to continue to work as financial legal experts. So let me just say that I think that like you were saying, the passage of the Bank Recovery and Resolution Directive and the establishment in the European Union of Banking Union with the single supervisory mechanism and the single resolution mechanism is a tremendous achievement and a tremendous step forward. And I think, that we, if someone would have told us, before the summer of 2012 that such a thing was going to be possible, we would have said that it would take many years, decades, for it to be achieved. And it is remarkable what we have achieved. But obviously, banking union is not perfect. To begin, there is only 2 of the 3 pillars that were established or in place. We still do not have a single deposit insurance scheme. And obviously that a euro in any member state, as my friend Christos knows very well, if you have it in a bank account, should be as valuable and as safe as a euro in any other member state, and therefore you shouldn't have any deposit flights. And as we know, this did not happen during the Eurozone debt crisis. So obviously a single deposit insurance scheme will go some way in order to solve where we are at the moment. It's also that banking union, it was designed with 3 pillars, but after all, it has more than 3 pillars. There is also the issue of fiscal support, and there is the missing pillar of banking union, which is the issue of lender of last resort, where emergency liquidity assistance remains at the level of the member states. And both Christos and myself have argued that that should be a pillar that should also be established at the level of the banking union, particularly now that supervision is no longer in the hands of the national authorities when it comes to the supervision of significant credit institutions. So that generally with regard to what is needed in Europe. What is needed around the world is that though the resolution framework has managed to achieve lex specialis when it comes to banks, we still have a huge divergence of procedures when it comes to bank insolvency. in those countries where there is bank insolvency, and some countries still have a lex generalis. And I think, that that is an area as a gap, as a whole. There is hope in the horizon. Actually, both Christos and myself were part of a new group that has been set up recently as part of UNIDROIT to work on the harmonization of bank insolvency proceedings, which are widely divergent, not just across Europe, but around the world. In Europe, of course, it's a further problem because while we have a harmonized resolution procedures, we do not have harmonized bank insolvency proceedings. We still have the winding up directive as the only measure that actually provides any degree of legislative convergence. So I'm sure that on these, on any of these things I just said, I could continue to speak, but so that Christos
Rosa, I'm sure we will come back to you to share more on that. Juana, we have taken the lead with corporate insolvency at EU level. At the moment, it's more advanced than, well, bank insolvency, but I don't know bank resolution. So it's kind of, we are there. We are with the restructuring directive focusing on corporations. We have, on the corporate sector, we have made a huge progress. Christos, same question as Rosa.
This is unfair.
Sorry, Rodrigo.
This is totally unfair. Yeah, you asked me a question after Rosa. I can simply say I fully agree with what Rosa said. Yeah.
I told you that I wanted to create some tension here. I want some disagreement.
This is not surprise that we agree. The fact remains that one missing point in the UNIDROIT group that Rosa mentioned, we have also Juana as a member. Yeah, we are both representing the European Banking Institute. That's great. So if I would add, I fully agree with Rosa with regard to the fourth missing pillar, as she first described it, the lending of last resort, especially also in my view for those banks which are being supervised by the ECB for the significant credit institutions, but not only. We know that the EDIS is missing, but I do not consider this as the major hurdle for several reasons. We can discuss that. The harmonization of insolvency rules is another missing element. We need to say, in addition, that we have a new banking package right now, the 2021 banking package. I'm preparing a paper on that for the EU Law Live Weekend edition in March. You will see that. Trying to describe the different pillars, mainly the alignment with the finalization of the Basel III proposals of 2017. We have new rules, and this is, in my view, not a missing element, but a new element, two new elements. The one is to translate the capital markets regulation rules on sustainable finance into banking rules, meaning that until now the taxonomy regulation and the sustainable finance disclosure regulation were mainly instruments of capital markets law, correct? They were included, as you all remember, in the Capital Markets Union Action Plan. And now we have new proposals included in this banking package, and on the basis of the EBA guidelines of June 2021 on making sustainable finance more binding also for the lending activity of credit institutions. And then we have new rules on digitalization, which will also affect the whole framework, including the MiCA in terms of level playing field in certain areas. But to close it here and open eventually a next round, if you wish to discuss that, there is one aspect which is quite alarming in my view, quite interesting if you wish, with regard to banking system stability, which cannot necessarily be addressed by legislation, and this is the profitability of the banking sector.
I think
I
that
stop here.
Eduardo, I'm coming to you in 1 second. Let me provoke a little bit Christos and Rosa. I'm coming to you in 1 second because you raised your hand, and Juana wanted to do an intervention before. I don't know if it's still topical.
No.
We can come back later, Juana. Thank you very much.
Yes.
I'm going to you, Eduardo, but before that, let me pose a question in the background to Christos and Rosa so they start thinking about it. Both of them mentioned lender of last resort, and we've been told, and I'm playing here a little bit of devil advocate, we've been told that there will be no more lender of last resort. We brought in bail-in, Dodd-Frank said that there will be no more lender of last resort. I know that in the BRRD, it says like, basically that's kind of an ultimate ultra last resort. But I would like to see why, I understand the obvious why we need a lender of last resort in certain instances, but I would like to see if you can expand a little bit more on your views on the lender of last resort and the role that that has vis-a-vis bail-in and other of the tools that being brought forward under the BRRD. But before we go that, Eduardo, you raised your hand, and we were talking a lot about the new rules, etc. But the reality is that from the banker's point of view, the whole new framework has made things very cumbersome for a bank. But I don't know whether you were coming in that direction or you had a different angle. But
yeah, that's a different angle. I want to share with you the vision within a bank. I'm sure that many banks will have the same. Maybe something that you don't see from outside is all the job that we are doing within the banks out of the Bank Recovery and Resolution Directive. We've been working a lot for the last 5 or 6 years, or 7 years now, if I say so. For example, just to give you some light, we are now more than 5 or 6 years in a row with recovery plans in place. We've done in dry runs, we have identified measures. We've done, we've been fine-tuning them, and they are fully in place. And we've worked a lot within the banks on the SRB expectation for banks in all the 7 lines of work. Most of all, we do have already the MREL in place and fully cover many of the banks. So for sure, there are gaps to cover, but if we compare with ancient times, as Martin said before, banks are far better prepared than before. We have to keep on working, but the amount of work that we've done internally, which is something that maybe you don't see from outside. For example, we have reorganized the group, making it more lean, clean, easy to resolve, and we internally have deployed a culture of having in mind not to create any barrier for resolution every time we take any decision within a bank, any strategic decision. So this is something that it's difficult maybe for you to get from outside, but I can tell you in the name of all the banks, we've been working a lot, and in the name of the SRB that have been following very closely and setting the expectation that there is a big difference of a bank now compared to what was before, just 6 or 7 years ago in the ancient times. That was my point.
Thank you, Eduardo. Eduardo, what's your reaction to, as a banker, with the issue of the lack of deposit guarantee system, in the sense that that's a pillar that we are missing in the banking union. When the banking union was designed, it was going to be resting over 3 pillars. We have common supervision, we have common resolution, but we still do not have the 3rd pillar, which is the common deposit guarantee scheme. What is your reaction to that, and whether? Sorry.
This is you're right. This is the missing piece, but it's my personal opinion is not that. It's not such a big drama. We do have a common rule book, we do have a common supervision, common resolution, and still the guarantee scheme, the fund guarantee scheme is national one, but it's harmonized through the directive. So every country has a guarantee scheme in place. We are heading for the full coverage of the 0.8% in 2024. It will be the same for all the countries through Europe. We wish it will be a common one, but still there is a national one that is in place and is ready to be used given the case. And bear in mind that this guarantee fund scheme will not be used probably for big banks. It is more for the small, medium-sized small banks. So I think that it is fit for the purpose right now. I mean, we wish it will be harmonized. It will not harmonized, it will be the same and single, but still we have something that can work perfectly.
Thank you, Eduardo. Martin and Juana, we know that after the collapse of Lehman, there was a lot of momentum. And that's why we managed to achieve in Europe many of the things that were achieved. Then some of that momentum started decreasing, and also the whole environment, the whole climate started changing. And there was also some political resistance, and the common deposit guarantee scheme in the end didn't come into effect. My question to both of you, and again, probably a little bit more detached from the core of banking law, do you see possible to overcome some of the current political obstacles in achieving a common deposit guarantee scheme? I don't know, Juana or Martin, who would like to go first? Martin, please.
Oh, no, I was going to say Juana if you want, but maybe just out of deference, no?
No, Martin, the floor is yours. You are our host. You are invited.
Very kind. Look, another confession, a second confession. I am an optimist by nature. So, and also I am pro-European by conviction. So I think because I'm an optimist, but also because I'm a pro-European, I am fully aware that the common deposit guarantee scheme it's a necessary pillar for the full achievement of a single capital market in the European Union. And I'm not the only one who believes that. I think the Commission as an institution and those who are responsible for that issue are fully aware of that. I think that there will be a lot of energy involved into making that happen, and I think things more difficult are currently being achieved. I'm going on a tangent note now, but if you think the huge challenges posed by the pandemic, which still is not over, but the reaction of the European Union, in particular regarding the health aspect, the vaccines, and so on and so forth, the COVID certificate, but also more importantly now as well, the recovery fund and the emission of debt by the Commission in order to fund this recovery fund. I mean, things much more difficult and perhaps more unthinkable at first have been made. I don't think therefore that it is too excessively optimistic, too naive to think that the common deposit guarantee scheme can be achieved. It is necessary in order to complete a real single market in the field of capital, and I think it's not very far away.
Juana?
No, I agree with Martin, nothing to add. But I would like to suggest another point. Because I think in banking resolution, the most important key feature, or even the most important problem, is the regulatory clampdown that implies the importance of the principle of no creditor worse off. I don't know if Martin can say to us something about the decision of the European Court on this topic, because as far as I know, the European court has in front a very important decision on this topic. And I don't know if you can.
Which I didn't get. I didn't get what is the judgment or the case that you mentioned, or the topic? Can you repeat, please?
Yeah, related to Banco Popular case.
Yeah.
And related to the resolution, banking resolution, I think the most important problem or the most important key feature is the regulatory clampdown that implies the principle of no creditor worse off.
Sure.
And as far as I know, the European Court has in front a very important decision on this topic.
Yeah.
And I don't know if you can.
I understand. What I can say is, well, two things. First of all, I'm not responsible for that case. I'm now at the Court of Justice. I was previously at the General Court, but I'm not the Court of Justice. So I actually not responsible for dealing with that case. If I were, I could not say anything. But since that is not the case, I can just share my views. So it's
all views are personal, Martin, and I'm going to reiterate this at the end.
Yeah.
So please.
Just personal views and based on my own thoughts, nothing more than that. I think there is a first and really significant question that needs to be addressed, which is a legal one, a purely legal one, which is actually admissibility, which is that who can bring an action for annulment against those series of decisions, because there is a number of interlinked decisions concerning the Banco Popular, some issued by the European Central Bank, some by the Single Resolution Board, some by the Commission itself. And in these hundreds of cases, there are challenges against all of them, basically. And they are challenged by a variety of entities. They are not challenged by the bank itself. If they were challenged by the bank itself, by Banco Popular, it would be easier. But they are not challenged by Banco Popular because Banco Popular didn't oppose its resolution, and the purchaser is obviously not unhappy with the resolution of the bank either. So the question is whether these other people, and it's a real question, the shareholders, the bondholders, or these stakeholders who have in reality an economic interest in the issue, are they actually legally entitled to bring an action for annulment against this series of decisions before the European courts? And actually, it's a really difficult decision to make, for which there is no direct precedent, because it's the first time that this mechanism has been put in place. So I think that's the first question that needs to be addressed, and the answer is not clear cut. I'll say just the following in relation to that. Typically, the Court of Justice, the case law of the Court of Justice, or the European courts, both of them, in particular the Court of Justice, tends to be quite legalistic as regards the requirements for as to who is entitled to bring an action for annulment. And that person is someone whose legal capacity is affected, directly and individually affected by the decision taken by the European institution. Legal capacity. So insofar as somebody is unhappy because the economic consequences of what has happened, it will not be easy actually to overcome that challenge. On the other hand, materially, I can understand full well. I mean, it's not complicated to understand that somebody who has realized that basically its shares are devoid of any value, its bonds have evaporated. That person, yeah, understandably is unhappy, but is that enough to bring an action for annulment against a decision of the European institutions addressed not to that person, but to somebody else because of the economic effects on that person? So that is a tough question, and I think the court will have to see how it puts in balance its traditional case law on this with material justice, and try to reconcile those two a priori, at first sight, not easily reconcilable legitimate interests. And that is before we can move on to the substance. And then if we pass that hurdle, then we can see whether the court will have to see whether actually what the institutions did with this series of decisions was correctly done. But there's a big if.
Martin, sorry, I interrupted. You finished? No.
No, yes, please.
Sorry, Martin. Basically, I can only stress the importance that these decisions have for the whole banking community, in the sense that, again, on the one hand, everything is so new, but also there's a great room of discretion for the EU authorities. And basically, I personally think that we need to fill in some of that void, and the way to do that is by means of these decisions. And it's not a critique to the norms that we have, but there are still too many open questions. And I think that basically this is the way, and that's why basically we celebrate. And I was jokingly saying that Christos, myself, Rosa, we will be ordering popcorn already and waiting eagerly to see that decision. Christos and Rosa, we have one of the questions of the audience brings back the issue of lender of last resort. And Christos, I will go with you so you don't complain that you go after Rosa. So now, please overshadow Rosa with your answer, so she has to agree on all of it with you. The question says, do you believe that the bail-in tool was efficient to convince the market that bailout would not be an option?
Oh, yeah. I have seen the question, but would you give me 2 minutes to go back a little bit to the single deposit guarantee scheme and my concerns on this? Yeah.
Sorry, yes, but clarify, when you say you're concerned that becoming a reality, not becoming a reality, or problems in
both
the
ways. Yeah. First of all, the EDIS one day will be in place. Yeah. We know that it's one of the pillars, and there has been a lot of effort been put to establish it. But I fully agree, and I said it also before, I think that Eduardo also mentioned that it's not a drama that we don't have it. Yeah. And I would say that, first of all, there is a misconception, not among us, but among the public. The existence of a European deposit insurance scheme is seen as backed by some public funds, yeah, which will not be the place. Which will not be the case. It will not be in place. The single deposit guarantee scheme will be funded by contributions from the credit institutions which are participating, correct? And it will be managed by the Single Resolution Board, at least according to the initial proposal. So, in my view, one of the issues that have to be discussed is the fact that these two funds, the Single Resolution Fund and the Single Deposit Guarantee Fund, yeah, should be two different funds within the same, under the same umbrella, or eventually be closely linked to each other. I would be very much in favor of the very, very initial proposal for an EDIRA, yeah, and a single fund for resolution and deposit guarantee. A second point, which brings me closer, so no high hopes, as the Pink Floyds would say, yeah, as David Gilmour would sing here, no high hopes, but again, a necessary element of the banking union. Now, we know that the resolution framework provides that when the failing or likely to fail decision has been taken by the supervisor, in principle, yeah, the main job of the resolution authority is to test the public interest criterion. And in this case, up to now, it has decided in most cases, unlike in the case of Banco Popular, that the bank should be closed down. And it is in these cases that the deposit guarantees are necessary. Yeah, and we really don't know. Eduardo, you mentioned before, it's mainly for the small banks. You are correct. And if you see even the deposit guarantee schemes directive, which is a min-max harmonization directive, it provides that a well-funded deposit guarantee scheme should have 2% of should be able to cover 2% of the deposits, yeah, meaning that it is by design, it should be for small banks. But again, the public interest criterion and the assessment does not lead necessarily to this conclusion. So one cannot exclude that a larger bank would not be bailed in or resolved in general. Yeah, so in that sense, deposit guarantee schemes still play a very important role. On the bail-in tool, very briefly, I think I'm very well known for being very critical to this tool. I do not believe that, especially under the circumstances which are prevailing today, if it were to be applied, that it would not, the cost-benefit analysis of that would be very much for cost and less for benefit. But not only for the small and unsophisticated persons and the small and medium enterprises, but also for the large enterprises. So I understand the market discipline argument, but again, I'm very critical on how this could be applied. In any case, the banks have been required by the Single Resolution Board, at least, yeah, to prepare themselves. Yeah, it looks like the main scenario will be that they had to prepare some 200 pages of a bail-in playbook, yeah, and all these details. So my understanding is that this will be the rule of thumb. Nevertheless, it's not the problem whether the bail-in should or should not be applied. The question is whether we already have bail-inable instruments sufficient for the bail-in to be applied. You know that very recently, on the 13th of January, the EBA issued some guidelines on the improvement of the resolvability for institutions on the basis of Articles 15 and 16 of the BRRD. So my understanding is that we are still in a phase where banks are not fully resolvable, and not all banks are resolvable. Depending now on which tool would be applied, yeah, the bail-in tool, if you don't have bail-inable instruments to absorb losses and to recapitalize the bank, yeah, then this would not be applied. I'm sorry to have been lengthy, but I will not speak again. Yeah.
Christos, no, I wanted to speak again, but we'll finish with a very quick question to all speakers. But I think basically these are no simple issues. Rosa, what's your reaction? And then Eduardo, I saw that you were agreeing with many of the things that Christos was saying, so I will come to you in a minute. Rosa, what's your reaction and what's your take on that question that we received on the chat?
Let me, before doing that, just very briefly, since you asked before about lender of last resort, and I think that Christos has already addressed the issue. Let me say that lender of last resort remains an important function. As we all know, lender of last resort comes in two forms. One is individual liquidity assistance, and the other is market-wide liquidity assistance. So the first form, which is the provision of collateralized lines of credits to individual illiquid but solvent banks, also called credit approach, is now in the Eurosystem the responsibility of the national central banks. And the second form, the provision of market liquidity assistance via open market operations or extraordinary measures such as quantitative easing, is the responsibility of the ECB. And during both the global financial crisis, but also during the pandemic, the European Central Bank has made very, very ample use of the market-wide liquidity assistance, and it has come up with a number of facilities. So I would like to say that lender of last resort remains an important function. With regard, just to add on the bail-in question to the question that Marcelo put in the chat, the bail-in, of course, is a tool, but it's also a philosophical approach. Clearly, with the taxpayer packages during the crisis, there was an uproar on the community, on the political community and international community of no more of exposing taxpayer money. So we have had a whole kind of philosophical revolution from bailout to bail-in. And to some extent, the bail-in tool is obviously a specific tool in which there are issues about the credibility of the tool. is not the only tool that is contemplated in the Bank Recovery and Resolution Directive, neither in the systemic key attributes, but is the one that kind of encapsulates this philosophical revolution. There is, as we all know, in the directive, obviously the opportunity for precautionary recapitalization and other mechanisms that still contemplate the opportunity of the use of public resources. But again, that should be the exception, not the rule. And so I would still like to preserve that philosophical revolution in thinking, which has been signified both with the key attributes and with the BRRD, of no more exposure to the extent that they were exposed during the global financial crisis of taxpayers' money in the way that it was both not only in the Eurozone, also in the UK and in the US.
Thank you, Rosa. And now I'm going to steal Christo's line. And yes, I agree completely with you on both counts. I mean, on that revolution and also the role of bail-in and kind of the dynamic between bail-in and lender of last resort. Eduardo, I don't know if you have any reaction to.
Yeah, yes, a quick one. I agree with Christos. I mean, we do have the playbooks already designed. We do have the MREL already completed. Just to give you a number, we have 56 billion of minimum required liability already in place, and we have an excess over that. So banks, we already got the crisis buffer completed. The only thing is that we hope the legal framework work and everything. Do not go.
We hope for the best, Eduardo. We always hope for the best.
And also remember that the Single Resolution Fund is at a level that is well above what we designed from the beginning. The numbers, I think that we already completed the 55 billion and we are on the way to getting closer to 70 billion. And it is very expensive for the banks to pay every year for that fund. So we hope that everything works. We already are paying for and it's very expensive to have the MREL in our books. We already paid and we will keep on paying until 24 for the Single Resolution Fund. We've done our job in terms of having the bail-in ready. I mean, there are things still to work, but we have plenty of time to be ready for, all the banks. So from my point of view, message to the market, there are gaps. Liquidity and resolution has to be solved, but we are more than half the way through the fully resolvable. So for everybody, just from within a bank, that I wanted to share that view.
Thank you, Eduardo. That was very helpful and being just on time. Let me, as a way of wrapping up, I would like to ask two very short questions, and I will expect a yes or no answer from the participants. Let's try to avoid elaborations. And it's just, I want to know two things that I think have been coming throughout this conversation today and just being provocative. Yes or no, do you see an NPL crisis or at least as an important hike in rates happening within the next year or so? I will go in the order I have you on my screen. Christos, yes or no?
Eventually, yes, but not to an extent that it would become a crisis.
Fine. Rosa, you're muted.
I'm not going to follow you, Rodrigo. It depends.
That's my line, Rosa. That's my line. That's my line.
In German, in German, they have for the yes or no, the word Jein, yeah, Ja und Nein. So it depends.
Eduardo?
No, my answer is no. Loans are better originated than in the previous crisis, and banks are better managed. So my answer is no.
Martin?
Without adequate knowledge, but just based on my optimism and following the opinion of Eduardo, I will go with him. And I hope that we will not face yet another crisis.
Juana?
I agree, absolutely agree with Christos and Rosa. It depends.
Okay. And let's see, just to ignite the debate and have a little bit of fun. Last question, yes or no? And clearly my panelists are not very good at following the rules. Let's see. Are we going to have a deposit guarantee scheme in the EU within the next 7 years? Christos, and now you're laughing.
This is long term, yeah. But 7 years is very long term, yeah.
Okay. Rosa?
I hope so. I cannot follow you with yes or no. You know, we've lived too long in the UK, and here, you know what happens with the rules.
Martin, you have answered this already. You have answered this already, but I just need to confirm that your optimism is still in place, and you answered this question before. Eduardo?
Absolutely. I say yes, but let me add as well that I think that we need as well to reform the economic governance of the European Union. So actually, we will have the deposit guarantee scheme and much more.
Thank you, Martin. Eduardo?
I will say yes. 7 years, we will have it.
Yeah.
And Juana, you said yes before.
Yeah, I will also say yes.
Okay. I think that we should all mark our calendars to have another event in 7 years from now, and we will revisit how we were, well, actually in a year to revisit the MPL, and in 7 years from now to revisit the Common Deposit Guarantee Scheme. I would like to thank you very much for your interventions. Thank you very much for your contributions. Rosa, you surprised me. I didn't know that you become an anarchist. You don't follow rules anymore. Thank you very much, everyone, for attendees, for joining us tonight, for the questions on the chat. Panelists, thank you very much for your interventions. I know that sometimes I push and I was a little bit thought-provoking, but that's part of the intention that we had with Juana when we were designing these webinars, to make this very dynamic, very interactive, and try to elicit a little bit of these conversations and probably even tension among panelists to have a fruitful discussion. I don't have anything else more to add, just to thank everyone, and in particular my friend, colleague, and co-organizer and her institution for this session of webinars. Juana, I give you the floor to close this event.
Yeah, so I just only want to say again, thank you very much for your cooperation. Thank you very much, Rodrigo. I think this webinar series has been a successful event. And one next year, because it is the last one, but next year we must talk about to repeat again the webinar series. Thank you very much, and we keep in touch.
Thank you very much, everyone.
Thank you.
Bye. Great pleasure. Thank you.
Thank you, Rodrigo and Juana. Ciao.
Bye.
Bye-bye.
Bye-bye.